Now that you understand what investing is and what to do before investing, let's talk about what beginners can invest in. There's so many options, so many things you can invest in. And this is where many people get stuck. We hear and see invest your money. But many people do not know where to start when it comes to investing, right? It's not really clear where exactly that money should go. And no one wants to make mistakes with their hard-earned money, right? So today we're going to be talking about asset classes. You can call it a category of investment or a type of investment. Growing up, we were taught classes of food: carbohydrate, proteins, fats, vitamins, mineral, water, each serving a different purpose, right? Carbohydrates was primary energy source for the body. And you had things like bread, rice. Proteins was for growth, repair of tissues. Another proteins, you had meat, you had fish, you had eggs, you had beans. I don't know, they say beans is not protein, but this is not a food class. But after every classes of food lesson, you'd always be taught a balanced diet, right? And I can't remember the exact definition of balanced diet now in primary school. Basically, a balanced diet is a meal of food that contains the right amount of the different classes or different types of food, right? So think about that and think about asset classes. They work the same way. Each asset class behaves differently. Each one carries a different level of risk. Each one serves a different purpose in building wealth. And so the best asset class for you might not be the best one for me, depending on goals, depending on income, depending on risk tolerance, and depending on even the time horizon as well. Now, let's break down the main asset classes that you should know. Number one is cash. Cash, cash, cash. Cash is the safest and simplest asset class. Think about the money in your bank savings accounts. Think about the money for your bills and daily expenses. Think about the money market funds. That's cash. Cash is easily accessible and very low risk. But here's the problem. Cash grows very slowly. Now, your average interest on savings is usually around 2 to 5%. In some cases, you see interest of 7% or 7.5%. On the other hand, inflation quietly reduces the purchasing power of that money over time. Even if your bank balance looks the same, what it can buy may reduce. Cash is good. Cash is great to have for things like emergency fund, which is about 3 to 6 months of your expenses, and also good for short-term needs, but it's not where long-term wealth is built. So after securing your emergency fund, after securing your money for bills and daily expenses, your excess cash should ideally be put to work in other asset classes, which we're going to talk about after now. The next one is stocks. Stock equities, equity stock, stock equities. Stocks are one of the most common asset classes and also one of the most talked about, and also one that people don't really understand. Well, stocks and cryptocurrency. Stocks is also another asset class. And this is how it works. When you buy a stock, you're buying a small piece of a company. You become a part owner of that company. For example, if you invest in companies like Apple or Google or a Tesla or Microsoft, you're owning a piece of those businesses. So you're a part owner of Apple, you are a part owner of Google and whatever company that you invest in. How then does your money make more money for you here? If the company does well, the value of your stock, the value of your investment can increase. Another way your money can make more money for you is through dividends. Some companies pay dividends. So if you own a part of a company, some companies can give you a share of the profits. Stocks can grow a lot over time, but they also go up and down, sometimes sharply, depending on the performance of the company or the business. Companies can underperform or even shut down. That's why stocks are considered higher risk than cash. However, historically, over the long term, stocks have delivered higher returns than most asset classes. But one important thing to understand, emotions like fear and greed cause many investors to buy high and sell low, which at the end of the day disrupts their long-term results. Now, number one principle when it comes to investment in stocks is to buy low and sell high. At the end of the day, you want to stick to the principle of buying low and selling high. Investing in stocks also requires a lot of patience and basic understanding. The next asset class is bonds. Bonds are different from stocks. When you buy a bond, you're basically lending money to a government or company, And what do you get in return? You get interest payments, which are called coupons over time. So you lend your money to the government or a company, they pay you interest, they return your original money at maturity as well. Bonds are generally less risky and more stable than stocks because they provide predictable income and they are less volatile. However, the returns are usually lower than stocks. For bonds, when the interest rate rise, the prices of bonds often fall and vice versa. So, as much as they are less volatile, they are not risk-free. They are not like totally risk-free. They just have lower risk compared to stocks. So bonds are useful when you want stability, regular income, and lower volatility. The next asset class is mutual funds. A mutual fund is like a money pot where many people put their money together, and on one side you have a professional fund manager investing it on their behalf in different asset classes. Now, different asset classes like stocks, bonds, or other assets. And at the end of the day, everyone would then share in the profits or in the loss, as the case may be. I always like to explain mutual funds using pizza. Now, imagine you and your friends are hungry and you want pizza, right? But say a whole pizza costs $100 and each of you only has $10. Now, 10 of you have $10 each, but the whole pizza is $100. Individually, you can't buy the whole pizza because you have $10, right? But if the 10 of you come together to put your money together, you can then buy the full pizza and share it in slices. Everyone takes a slice of the pizza, right? A mutual fund is like buying a big pizza together. So everyone contributes a small amount basically and gets their own slice of investment, and the fund manager, which in this case, the chef, Domino's or whoever is making the pizza, make sure that the pizza is invested wisely in different asset classes. Mutual funds are very beginner friendly. It helps with diversification and it's good for beginners who just want a simple way to invest in a broad range of assets. But the only thing here is you do not control the individual investment inside the fund. So you have to be careful what mutual funds you're investing in. The next asset class is index funds and ETFs. This is like the most popular investment options. Everywhere you go, index fund, ETFs, ETFs, ETFs. Basically, what is an index fund? An index fund is a type of mutual fund that tracks the performance of a specific market index. A popular example is the S&P 500. Now, what does the S&P 500 mean? The S&P 500 is an index that represents the top 500 US companies across different sectors. So when you invest in an S&P 500 index fund, for instance, your money is spread across different companies. So this means that you're not picking one company, you're not investing in one company, you're buying the market. And major examples of companies in the S&P 500 index include industry giants like Apple, Microsoft, Amazon, Tesla, ExxonMobil, and what have you. ETFs are exchange traded funds. They often track the same indexes as index funds, but they trade on the stock exchange like a regular stock. I'm going to do another video where I'm talking about ETFs and breaking it down. But ETFs are really popular because they are low cost, they're diversified, they're simple, they're safe, and they're beginner friendly. With one investment, you get exposure to hundreds of companies. But remember that if the overall market drops, then your investment will drop as well. So you also need to be careful because some ETFs are focused on specific industries or sectors or trends, and those ones can carry a higher risk. Real estate is another asset class of property, and this includes physical properties, rental apartments, commercial buildings, land, short-term rentals. Real estate can generate money through rental income and appreciation over time. It's very different from bonds and stocks. However, real estate usually requires large upfront capital. It requires maintenance, it requires time, and it requires management. There are also other asset classes like commodities and alternative investments, but those are not really beginner friendly. But when you talk about commodities, they're like physical raw materials bought and sold in global markets. You're talking about gold, you're talking about oil, you're talking about cocoa, agricultural products. So it's not really beginner friendly because predicting commodity prices require understanding of global trends. It also requires understanding of complex trading instruments like future contracts. And then you also have digital asset like cryptocurrency, which is the most misunderstood asset. It's very exciting, very unpredictable. Crypto is highly volatile. It can rise fast and fall even faster. So if you're a beginner and you cannot emotionally handle the large swings, you need to approach this with caution. Only invest what you can afford to lose. And you have alternative investments like options, derivatives, hedge funds, private equity, even art and collectibles. But the main asset classes are the ones I've mentioned. We've talked about cash, stocks, bonds, property, index funds, ETFs, and you also have commodities and alternative investments as well. Know that these are just different asset classes. You don't need to invest in everything. You just need to choose what aligns with your goals, choose what aligns with your risk tolerance and even timeline as well. Investing is not about owning everything. It's about owning the right things for you. You don't need to invest in everything. As exciting as investing is, just choose what aligns with your goals. In summary, asset classes are categories or types or groups of investment that behave similarly. They help you understand risk. They help you understand return. They also help you to understand how to diversify. And we've talked about the common asset classes like cash, stocks, bonds, property, commodities, alternatives. Understanding asset classes helps you make smarter investment decisions. Whether you're starting with small amounts, it's very important that you understand the different asset classes. Found this video helpful? Ensure that you like this video, save it, subscribe to this YouTube channel, and let me know in the comments what asset class you'd like to learn more about in the next videos.